All right, so when you think about investing in the American auto industry, what's the first thing that pops into your head? Probably gleaming factories, right? Iconic brands like Ford and GM. Well, we're about to show you why the real lasting profits are actually hidden far, far away from the assembly line, in places you'd probably never even think to look.
Yeah, of course. Our minds jump right to the car makers. I mean, they're the titans of industry, they're symbols of American manufacturing. But what if I told you that for an investor, focusing on those giants is a huge mistake, that the real compounding returns are found somewhere else entirely?
Because here's the big twist. The most famous companies can actually be the absolute worst investments. The real value isn't in the sexy, high-tech manufacturing. It's in the, well, boring stuff. The overlooked services that keep cars running, insured, and eventually recycled.
Okay, so let's start by digging into this really counterintuitive idea that the very companies building the cars we drive are often just giant traps for capital, constantly sucking in more money without actually delivering real returns to their investors.
And to really get this, we have to look past the impressive factories and those massive revenue numbers. We've got to peel back the layers and look at the cold, hard financials, which, believe me, tell a very, very different story. It's a story of value destruction.
Now, okay, this might look a little complicated, a little bit like financial jargon, but the idea is actually super simple and incredibly powerful. Just think of it like this. ROIC is what a company earns on the money it invests in itself. WACC is what that money costs them to get in the first place. So if what you're earning is less than what it's costing you, you're literally getting poorer with every dollar you spend. And when you look at the report card for companies like Ford and GM, it's not a pretty picture. I mean, look at Ford. They're earning, at best, maybe 4.8% on their investments, but it's costing them 7.2% to fund those investments. That negative spread means they are consistently destroying shareholder value every time they build a new factory.
And you know what's pouring gasoline on this fire? This whole double transition to EVs and self-driving cars. It forces them to spend billions. I mean, GM is spending over 6% of its revenue on R&D just to keep up. This isn't spending to get ahead, it's like running on a treadmill that's getting faster and faster just to stay in the same place.
This chart just lays it all out there, crystal clear. Look at that blue bar for the car makers. It's struggling, bouncing all over the place, just to get above that gray line, which is their cost of capital. Now compare that to the nice, healthy green bar for other industries. It just shows you this is a fundamental weakness baked into the business model itself.
So, if the glamorous business of building cars is a financial black hole, where's the smart money going? Well, let's shift gears now and focus on the less obvious but way more profitable back end of the mobility universe.
The answer, it turns out, is in companies that have built these incredible, powerful, and durable competitive advantages, what investors love to call moats. You know, just like a medieval castle, these moats protect them from competitors and let them generate fantastic returns year in and year out.
First up, let's talk about the auto parts guys. Their whole business is built on something that's not price, but something much more powerful: speed.
Put yourself in the shoes of a professional mechanic for a second. When a car is up on their lift, every single minute that bay is occupied, they are losing money. They can't afford to wait a day for a part to show up from some online warehouse. This amazing logistics network that gets them the right part in under an hour, that is a moat that even the biggest e-commerce giants can't seem to cross. And here's the magic number that's a huge tailwind for this entire business. Cars on the road today are older than they have ever been before. And older cars mean more things break. Alternators, water pumps, you name it. For most people, fixing their car isn't a choice, it's a necessity.
Okay, from parts, let's go to the end of a car's life. This whole part of the industry is dominated by what they call a silent duopoly in the salvage auction business. And the leader of that pack is a company called Copart. What Copart has built is just this genius combination of a physical, real-world empire and a killer digital network. They own these huge plots of land near big cities that are basically impossible for anyone else to get because of zoning laws. Then they built this global online auction platform on top of it, creating a flywheel where more sellers attract more buyers, which attracts more sellers. You get the idea. All right, last stop on our tour of hidden profits, the financial nervous system of the whole industry. We're talking about data-driven insurance, and this is where a company like Progressive has built this massive moat out of nothing but pure information.
You've got to hear this quote from their management. It says everything. It's just dripping with confidence. They've collected so much data for so long that they believe their ability to price risk is perfect. So perfect, in fact, that if you leave them for a cheaper price, they figure you are going to be an unprofitable customer anyway. It's an incredible display of a data advantage.
All right, so let's bring it all home. Let's look at the ultimate scorecard and see what this all really means for anyone trying to build long-term wealth in this space. I mean, the numbers here really speak for themselves. It's not even close. Over 10 years, companies in the back end, salvage auctions, auto parts, have compounded wealth at these incredible rates, over 20% a year. And in that same time, the big-name manufacturers, they've basically gone nowhere for investors.
And here's their secret sauce. A lot of these winning companies are what we call corporate cannibals. They make so much cash and they don't need to spend a lot of it on new factories. So what do? Instead of risky acquisitions, they just buy back their own stock, relentlessly shrinking the number of shares and making each remaining share more and more valuable over time.
So what's the big lesson here? It's pretty simple, actually. The real, lasting profits in the auto world aren't in building the car itself. They're in the whole ecosystem of essential, high-margin services that support that car through its entire life, from its first oil change to its final trip to the salvage yard.
So yeah, the next time you see one of those shiny new cars roll off an assembly line, I want you to remember where the real value is being created. It's probably not in that factory. It's in a dusty warehouse, or a busy repair shop, or deep inside the complex algorithms of an insurance company. Makes you wonder, doesn't it? What other industries are out there where we're all looking at the glamorous front end and missing the real story?